You're sitting on your couch holding your phone, and you open up one of those free credit monitoring apps. You know the ones. Maybe it's built right into your banking app, or maybe it's a standalone service you signed up for a few years ago. You log in, the screen loads with a little spinning wheel, and then a massive, brightly colored dial pops up on the screen. You look at the number in the center of the dial. It says 698. And instantly, your stomach just kind of drops. You feel this hot flash of panic, followed immediately by a profound sense of failure. Last month, that number was 715. It was in the green zone. You were a good person. But now, it's 698. It's in the yellow zone. The app even gives you a little sad face icon or a notification that says, "Oh no, your score dropped 17 points." You start frantically clicking around trying to figure out what you did wrong. You didn't miss a payment. You didn't open a new credit card. You didn't buy a house. You just paid your regular bills, went to work, and existed. But somehow, you are being punished. You feel like you just got a terrible grade on a test you didn't even know you were taking. And worse, you have absolutely no idea how to study to bring the grade back up. It's Karen. I spend a lot of time looking at the rules of money, and honestly, the older I get, the more I realize that most of these rules were entirely made up by massive corporations just to keep us exhausted, confused, and highly profitable. And there is absolutely no system more perfectly designed to manipulate your emotions, extract your wealth, and keep you on a permanent financial treadmill than the modern American credit scoring system. We have been brainwashed into believing that our 3-digit credit score is a reflection of our moral character. We think it is a permanent record of our financial maturity. We brag about it at dinner parties, we stress about it at 2 a.m., and we literally base our self-worth on whether an algorithm in a server farm somewhere decided we are a 750 or a 620. But right now, in 2026, with interest rates absolutely suffocating the middle class and credit card debt hitting historic, terrifying highs, we have to wake up. We have to tear down the mythology of the credit score. Because your credit score is not a measure of how good you are with money. It is a measure of how profitable you are to a bank. It is an I love debt score. And the companies calculating that score are not government agencies looking out for your best interests. They are private, for-profit data brokers who are selling your financial anxiety to the highest bidder. Today, we are going to completely dismantle the credit score illusion. We are going to look at the bizarre history of how this number was invented, break down the incredibly toxic math of how it actually works, and expose the gamification trap that keeps you swiping your card. Most importantly, I am going to show you exactly how to step off the treadmill, read the system like a cynical CFO, and protect your actual wealth. Grab a cup of coffee. We have a lot of deprogramming to do. The first thing we have to dismantle is the user interface of your financial life. We have to talk about how the banking industry successfully turned the act of borrowing money into a video game. Think about what happens when you open one of those free credit score apps. The design is not an accident. They use bright colors, massive dials, progress bars, and push notifications. When your score goes up by 5 points, they send you an alert with little digital confetti. "Congratulations, you're doing great, keep it up." When your score goes down, they send you an urgent, anxiety-inducing red alert. "Warning, your score dropped. Click here to find out why." This is called gamification. It is the exact same psychological engineering used by social media companies to keep you scrolling and by casinos to keep you pulling the lever on a slot machine. They are hacking your brain's dopamine reward system. But what is the actual goal of this game? Why does a massive tech company offer to monitor your credit for free? Because you are the product. When you log in to check your score, the app inevitably shows you a curated list of recommendations. They tell you, based on your excellent 720 credit score, you have outstanding odds of being approved for this new premium travel rewards credit card. Or you could lower your monthly payments by consolidating your debt with this personal loan. The entire app is a multi-billion-dollar affiliate marketing funnel. If you click that link and open the new credit card, the app developer gets a massive commission from the bank, sometimes hundreds of dollars for a single click. They use the gamification of the score to keep you emotionally invested and logging in every week so they can constantly serve you targeted advertisements for more debt. They want you obsessing over the number so that you feel a sense of pride when you get approved for a card you don't actually need. They have successfully convinced the middle class that the ultimate goal in life is not to have money in the bank. The ultimate goal is to have the ability to borrow money from the bank. It's a brilliant, terrifying psychological trap. You are playing a game where the only way to get a high score is to remain permanently tethered to the lending industry. To really break the emotional hold this number have on you, you need to understand where it came from. Because we tend to treat the credit score like it is a fundamental law of physics, we treat it like gravity or the speed of light, something that has just always existed and cannot be questioned. Let me give you a reality check. The FICO score, which is the standard 3-digit number used by almost every lender in America, was not widely introduced until 1989. That's not ancient history. Your parents bought their first cars and their first houses without a FICO score. Before 1989, lending was a highly localized, deeply human process. If you wanted a loan to buy a house, you walked into a bank, sat down with a loan officer, and you talked. The banker looked at your income, your job history, your savings account, and your standing in the community. They made a holistic human judgment about your character and your ability to repay the debt. Now, was that system perfect? Absolutely not. It was incredibly slow, heavily biased, and often deeply discriminatory. But the solution the banks came up with, the FICO score, was not designed to make lending fairer for the consumer. It was designed to make lending faster and cheaper for the banks. In the late 1980s, the banking industry was undergoing massive consolidation. Local community banks were being swallowed up by massive national megabanks. These megabanks wanted to issue millions of credit cards and thousands of mortgages across the country as fast as humanly possible. They couldn't afford to have a human being sit down and interview every single applicant. It was too expensive and it didn't scale. So they turned to a company called Fair Isaac Corporation, FICO. FICO created a statistical algorithm. They took all the messy, complicated data of a human life, fed it into a computer, and spit out a single 3-digit number that represented statistical risk. The bank no longer had to look at you. They just looked at the number. If the number was above 700, the computer automatically approved the loan. If it was below 600, the computer automatically denied it. The credit score was invented to mass-produce debt. It was a tool of corporate efficiency, designed entirely to lower the underwriting costs of massive financial institutions so they could aggressively expand the consumer credit market. It was never meant to be a report card for your life. It was just a corporate shortcut. When you understand that history, you stop taking the number so personally.
Okay, so we know it's a shortcut, but how does the shortcut actually work? What is the algorithm actually measuring? If you ask the average person on the street what makes a good credit score, they will say, well, you pay your bills on time, you have money in savings, and you don't go into debt. That makes logical sense, but it is entirely mathematically wrong. Your credit score is calculated using 5 specific categories of data. And when you look closely at these 5 categories, you realize that the system is actively punishing financial independence and rewarding permanent reliance on credit. Let's break them down. First, payment history, 35% of your score. This is the only part of the score that actually makes common sense. Do you pay the people you owe on time? If you miss a payment, your score tanks. If you pay on time, your score stays healthy. Fair enough. If you borrow money, you should pay it back when you promised. Second, amounts owed/credit utilization, 30% of your score. This is where the manipulation begins. This measures how much debt you currently have compared to how much credit the banks have offered you. We're going to dive deep into this specific trap in a minute because it is the most infuriating part of the entire system. Third, length of credit history, 15% of your score. How long have your accounts been open? The older your accounts, the better your score. But look at how this punishes good behavior. Let's say you spend 5 agonizing years paying off a massive student loan. You send in that final payment, you celebrate. You are officially debt-free. You did exactly what you were supposed to do. What happens to your credit score the next month? It drops, sometimes by 20 or 30 points. Why? Because you closed an old account. The algorithm doesn't see a responsible adult achieving financial freedom. The algorithm sees a consumer who just removed a major piece of lending history from their file. You stopped playing the game, so you lose points. Fourth, new credit, 10% of your score. Every time you apply for a new loan or a new credit card, the bank does a hard pull on your credit report, and every time they do that, your score drops a few points. The system assumes that if you are asking for money, you must be desperate, so it dings your score. But you need to ask for money to build a history. It is a catch-22 designed to keep you anxious. Fifth, credit mix, 10% of your score. This is the most ridiculous metric of them all. The algorithm rewards you for having a diverse portfolio of debt. They want to see that you have a credit card, an auto loan, and a mortgage. Think about the sheer insanity of this. If you are a completely responsible person who saves up cash to buy a used car outright, the credit bureaus look at you and say, we don't like that. You only have credit cards. You don't have an installment loan. We are going to lower your score because your debt isn't diverse enough. They are explicitly rewarding you for paying interest to a bank for a car you could have bought with cash. When you look at the whole picture, the truth is undeniable. A credit score does not measure your wealth. It does not look at your income. It does not look at your savings account, your investments, or your net worth. You could have $1 million sitting in a checking account, and if you've never borrowed money from a bank, your credit score will be 0. The FICO score is an I love debt score. It simply measures how profitably you interact with the banking sector.
We need to circle back to the second category, credit utilization, because this is the mechanism that drives most people absolutely insane. And it is the reason your score randomly drops 17 points on a Tuesday for no apparent reason. Utilization makes up 30% of your score, making it the second most important factor. It is simply a ratio of how much credit you are using versus how much credit you have available. The golden rule that every personal finance blog preaches is that you must keep your utilization below 30%. If a bank gives you a credit card with a $10,000 limit, you should never, ever let the balance go above $3,000. If you cross that invisible 30% threshold, your score immediately starts to drop. Let's pause and appreciate the profound psychological manipulation happening here. The bank ran your credit, looked at your income, and officially determined, we trust this person with $10,000. They handed you a piece of plastic that literally says $10,000 on the approval letter. But it's a lie. It's a trap. If you actually use the $10,000 they just gave you, even if you have the cash in the bank to pay it off the next day, the credit bureaus will instantly penalize you. They will tank your score, label you a high-risk borrower, and potentially trigger other banks to lower your limits or raise your interest rates. They give you the rope, and then they penalize you for holding it. Why do they do this? Because it keeps you constantly insecure. It forces you to play a ridiculous game of timing. Let's say you use your credit card for all your monthly expenses to get the points. You spend $4,000 a month on groceries, gas, and utilities. You pay the balance in full, down to 0, on the due date every single month. You never pay a dime in interest. You are doing everything right. But your credit score keeps fluctuating wildly. Why? Because the credit card company does not report your balance to the bureaus on your due date. They usually report your balance on your statement closing date, which is several weeks earlier. So even though you are going to pay it off, the bank reports to Experian that you are carrying a $4,000 balance. If your limit is $10,000, your utilization is 40%. The algorithm triggers, your score drops, and you wake up to a panicked alert on your phone. To beat this specific trap, you have to log into your account and pay your balance before the statement even closes. You have to prepay the debt you haven't even officially been billed for yet, just to manipulate the ratio so the computer doesn't get mad at you. Or the system forces you into an even darker trap, chasing limit increases.
People realize that if they want to spend $4,000 a month without ruining their ratio, they need a higher limit. So they call the bank and ask for a limit increase to $20,000. The bank happily obliges. Now the 30% ratio is satisfied. But what just happened? The bank successfully convinced you to expand your available debt. They gave you more rope. And human psychology dictates that when you have more available credit, you eventually spend more money. You inflate your lifestyle to match the new limit. The utilization rule is not about safety. It is a behavioral nudging tool designed to keep you constantly asking the bank for more capacity, which inevitably leads to more debt. To truly free yourself from the anxiety of the credit score, you have to understand who is actually calculating it. You have to look at the three major credit bureaus: Experian, Equifax, and TransUnion. We tend to treat these three entities with a level of reverence usually reserved for government agencies. We talk about them like they are the Supreme Court of Finance. We assume they are impartial, highly regulated, official arbiters of truth. They are none of those things. Experian, Equifax, and TransUnion are massive, private, for-profit, multinational corporations. They are data brokers, and they are operating one of the most brilliant, entirely legal, deeply unethical business models in the history of capitalism. Let me explain how their business works. First, they collect your data for free. Every time you make a payment, miss a payment, apply for a loan, or default on a debt, your bank takes that information and hands it over to the three bureaus. The bureaus do not pay you for this data. You have no right to privacy in this transaction. Your financial life is harvested automatically. Second, they take your free data, run it through the FICO algorithm, and generate a product, your credit profile and your score. Third, they sell that product. Who do they sell it to? They sell it back to the banks. When you apply for a mortgage, the bank pays Equifax a fee to pull your file. The bureaus are making billions of dollars selling your harvested data back to the financial institutions that want to lend you money. But wait, it gets better. They aren't satisfied just selling your data to the banks. They want to sell it to you, too. This is the ultimate grift. The credit bureaus will routinely send you emails or advertise services saying, "Identity theft is on the rise. Protect your credit score. Pay us $19.99 a month for premium credit monitoring." Let's unpack that. A massive data broker harvests your personal information without your explicit daily consent. They compile it into a highly vulnerable centralized database. And we all remember the 2017 Equifax data breach, where the personal information of 147 million Americans was stolen because the company failed to implement basic security patches. After putting your data at risk, they then turn around and charge you a monthly subscription fee to alert you if someone steals the data they failed to protect. They are creating the anxiety, creating the vulnerability, and then selling you the cure. It is a protection racket. When you understand that Experian and Equifax are just massive marketing and data harvesting corporations, you stop viewing your credit score as a moral judgment. It is just a product they built to sell to Visa and Chase. You do not owe them your emotional peace of mind. If the credit score only mattered when you wanted to borrow money from a bank, it would be annoying but manageable. If you didn't want a loan, you could just ignore it. But over the last 2 decades, the credit reporting industry executed a massive, highly successful lobbying campaign to integrate their product into absolutely every facet of modern American life. They realized that the more industries they convinced to use their score, the more data they could sell. This is what I call the credit creep, and it is acting as a massive silent tax on the working class. Did you know that in almost every state in America, your car insurance company pulls a version of your credit score to determine your monthly premium? They argue that there's a statistical correlation between poor credit and filing insurance claims. So if you are a perfectly safe driver, you have never been in an accident, you have never had a speeding ticket, but you have a 620 credit score because you had medical debt 3 years ago, your insurance company will charge you significantly more for coverage than a terrible driver who happens to have an 800 credit score. You are paying a permanent financial penalty for a past mistake that has absolutely nothing to do with your ability to operate a motor vehicle safely.
It crept into housing. Try renting an apartment right now without a credit check. Corporate landlords use the score as an absolute inflexible filter. If you don't hit their arbitrary number, your application goes straight in the trash. It doesn't matter if you have a great job, glowing references, and a massive security deposit in cash. The algorithm says no, so the landlord says no. It even crept into employment. Major corporations now run credit checks on job applicants. If you lost your job during a recession, fell behind on your credit card bills, and ruined your credit, that exact ruined credit will now prevent you from getting the new job you desperately need to pay off the debt. It is a vicious, inescapable cycle. The credit bureaus successfully convinced society that a three-digit number representing your profitability to a bank is actually a proxy for your moral reliability as a human being. They monetized our judgment of each other. By forcing the score into insurance, housing, and employment, the system ensures that being poor is incredibly expensive. If your score drops, every other baseline cost in your life goes up. It is a trap designed to keep the middle class permanently exhausted and constantly paying a premium just to participate in society. All right, we know the history, we know the math is toxic, we know the bureaus are just data brokers, and we know the score has infected everything. So what do we do? If we have to live in this system, how do we navigate it without losing our minds and our money? You have to completely change your relationship with the number. You have to stop acting like an anxious student waiting for a report card, and you have to start acting like a cynical chief financial officer. A CFO does not care about getting a gold star. A CFO only cares about leverage, risk mitigation, and protecting capital. Here is your defensive playbook. Step 1, freeze it and forget it. The absolute most powerful thing you can do to take your power back from the data brokers is to freeze your credit. By law, you have the right to contact all 3 major bureaus, Experian, Equifax, and TransUnion, and place a security freeze on your file. It is completely free. When your credit is frozen, no one can view your file. The bureaus cannot sell your data to a new lender. If an identity thief tries to open a credit card in your name, the bank will hit a brick wall and the application will be denied. But more importantly, it creates a massive psychological barrier for you. When your credit is frozen, you cannot impulsively apply for a store credit card to save 15% at the register. You cannot easily finance a car you can't afford. You have to purposefully log in, thaw your credit, and wait. That friction is your best friend. Freeze your credit today and only unfreeze it on the rare occasion you actually need to apply for a mortgage or a lease. Step 2, automate the game. Stop checking the app. I want you to delete the free credit monitoring apps off your phone. I am serious. Delete them. You do not need a push notification telling you your score dropped 2 points because the wind blew. It is inducing unnecessary anxiety. Instead, automate the only part of the score that actually matters, payment history. Set every single one of your bills and credit cards to auto-pay minimum balance. Even if you plan to pay the card off in full manually, setting the baseline auto-pay ensures that you will never, ever accidentally miss a payment and trigger a 30-point penalty. Let the machines handle the baseline. You focus on generating actual income, not managing a digital score. Step 3, keep the anchors, cut the noise. Remember that the algorithm rewards the length of your credit history. This is the one rule we will play along with because it requires 0 effort. Identify your oldest credit card, the one you opened in college or when you got your first job. That is your anchor. Do not close it. Even if you never use it, keep it open. Put a tiny recurring subscription on it like Netflix or Spotify and set it to autopay. It sits in a drawer, silently aging and providing a massive foundational boost to the average age of your accounts. Once your anchor is set, stop chasing new cards. Stop playing the utilization game by asking for limit increases. You do not need a diverse mix of debt. Step 4. Focus on net worth, not FICO. This is the final, most crucial mental shift. You have to start measuring the right numbers. The banks want you staring at your credit score because it distracts you from your net worth.
If you have an 800 credit score, but you have $40,000 in auto loans, $15,000 in credit card debt, and $0 in a retirement account, you're not successful. You are broke. You are highly leveraged, highly vulnerable, and highly profitable to the banking sector. You are one medical emergency away from total collapse. Conversely, if you have a 680 credit score, but you have zero consumer debt, a fully funded 6-month emergency fund, and a high-yield savings account, and you're maxing out your 401k, you are wealthy. You have absolute freedom. You are financially bulletproof. I promise you, the peace of mind that comes from having liquid cash in the bank is infinitely more powerful than the temporary dopamine hit of seeing a 750 on a brightly colored app. When you shift your focus from borrowing capacity to actual wealth accumulation, the credit score loses its power over you. It becomes nothing more than a minor administrative hurdle you occasionally deal with when renting an apartment.
I know it feels exhausting to realize that the rules we were taught are basically a corporate manipulation tactic. We all grew up hearing our parents stress about their credit, and we internalize the idea that maintaining this number is the ultimate hallmark of adulthood. It takes a profound amount of mental energy to unlearn that programming. It is entirely okay to feel angry that private data brokers harvest your information to sell you anxiety. It is completely rational to be furious that a late payment from 4 years ago is currently making your car insurance more expensive today. The system is structurally unfair, deeply opaque, and heavily biased toward permanent debt. But anger won't pay your bills, and complaining about the bureaus won't lower your interest rates. The only way to win this game is to refuse to play it on their terms. You have to look at the massive flashing dial on your phone screen, realize it is an illusion designed to sell you credit cards, and just walk away. Your worth as a human being is not calculated by an algorithm in an Equifax server room. Your financial security is not determined by how much money a bank is willing to lend you. Your security is determined by the cash you hold, the debt you eliminate, and the boundaries you draw around your own household. So tonight, freeze your credit, delete the app, stop stressing about a 12-point drop in a fake number, and start focusing the real math of your own life. Because the banks want you anxious, but you are far too smart to fall for the trap. You've got this. I'll see you in the next one.